Let me start with the setup and the rules, because the rules are what made this experiment meaningful and what would make it meaningless if I violated them. The rules. Rule 1. No overrides. Any Tickeron AI robot signal that met my predefined criteria for asset class and position size, I took the trade. I could not skip a signal because I didn't like the setup. If the AI said buy, I bought. Rule 2. No additions. I could not add to winning positions beyond what the AI signal specified. No, this one looks really good, let me size up. The AI sets the position parameters. Rule 3. Paper trading account. I want to be completely transparent about this. This was a simulated account with paper money. $25,000 starting balance. Trading in real-time market conditions. Real prices, real fills simulated at market price. I did not risk live capital on an untested 30-day experiment. Anyone who does otherwise is taking on unnecessary risk. I'll talk about what would change with real money at the end. Rule 4. Every trade logged. TradeZella was my journaling tool for this entire experiment. Every trade entered: ticker, entry time, entry price, signal source, position size, exit time, exit price, outcome, AI confidence rating at signal. This is the only way to have credible results. If you're trading without a journal, you're relying on memory, and memory is not a reliable data source when it comes to your own trading performance. If you're not journaling your trades, TradeZella is the tool I use and recommend. Link in the description. It connects to most brokerages directly and auto-imports your trades, so the friction of journaling is minimal. On-screen graphic. What is Tickeron AI? A 2-minute explanation. Tickeron AI explained. Tickeron's AI doesn't generate signals the way most indicators do. It doesn't use RSI crossing a threshold or MACD line crossovers. It uses pattern recognition across a historical database, decades of price action across thousands of symbols, and has calculated the historical outcome frequency for specific chart patterns, setups, and conditions. When you subscribe to an AI robot, you're subscribing to a specific trading model. Each robot is specialized. Some are optimized for day trading momentum, some for swing reversals, some for options volatility. Each robot has a public performance dashboard. You can see its win rate, average gain per trade, average loss per trade, and recent performance before you subscribe to it. For this experiment, I selected 3 robots. One momentum day trading robot focused on US equities, one swing trading robot focused on mid-cap technical setups, and one AI robot focused on ETF signals. The intent was diversification across style and time frame. The AI outputs a signal with a stated confidence percentage. Higher confidence signals have historically performed better in Tickeron's own data. I set a minimum confidence threshold. I only took signals rated 70% or higher. Below that, the signal was skipped. This was the only discretionary filter I allowed. Week-by-week breakdown. Week 1. Finding the rhythm. The first week was uncomfortable in a very specific way. The AI took 2 trades on day 2, a long on a mid-cap industrial and a short on a retail ETF, that I would never have taken myself. The setups looked messy to me. The industrial had just gapped down, and the AI was buying the gap. My instinct screamed no. I took both trades, both won. Not big, 0.8R and 1.1R, but they won. And that was the first lesson. My instinct is also a bias engine. My read of those setups was shaped by pattern preference, not statistical edge. Week 1 results: 8 signals. 6 taken at or above the 70% confidence threshold. 4 wins, 2 losses. Net positive week. Starting to build data. Week 2. The tariff weeks. Weeks 2 and 3 were the hardest weeks. Mid-March, tariff escalation announcements were hitting in waves. Sectors were moving aggressively. The market was not trending in any clean direction. It was reacting to news events that had no technical precedent on the charts the AI was reading from. Week 2, 11 signals. 9 taken. 4 wins, 5 losses. First losing week. Net 3.2R. This is where the no override rule created real psychological pressure. On day 9, the AI generated a long signal on a semiconductor name during an intraday sell-off that was clearly macro-driven. Tariff news specific to that sector. Every fiber of my trading experience said, do not take this trade. The macro environment will overwhelm the technical setup. I took the trade. It stopped out. Full loss. And here's what's interesting about that loss. It's not actually a signal that the AI is broken. It's a demonstration of the AI's structural limitation. It reads price and pattern. It does not read news. It cannot integrate an intraday macro catalyst that emerged after the overnight signal was generated. That's not a bug. It's a design constraint you need to understand and build a protocol around. More on that in the final recommendations. Week 3. Stabilization. Week 3 was a recovery week. The market found temporary footing after Fed commentary provided some clarity, and the AI robots, particularly the momentum day trading robot, performed well in the cleaner trend conditions that emerged in the latter part of the week. Week 3, 9 signals, 8 taken. 5 wins, 3 losses. Net positive 4.8R. Best week of the experiment. The ETF robot had a notably strong week. It flagged a sector rotation into utilities and healthcare that the broader market eventually followed. The AI catching a sector rotation early was one of the more impressive moments in the 30 days. Week 4. Finishing the experiment. Week 4. 13 signals. 11 taken, 2 below confidence threshold. 7 wins, 4 losses. Net positive week. Comfortable margin. By week 4, something had shifted in how I was experiencing the process. The psychological discomfort of the first 2 weeks had largely resolved. Not because the AI was winning more consistently, the win rate was relatively stable throughout, but because I had developed trust in the process. I had stopped second-guessing signals and started analyzing outcomes. There's a difference. Second-guessing is emotional. Analyzing outcomes is systematic. On-screen graphic. 5 winning trades, walked through. 5 winning trades. Trade. 1, day 3. Industrial gap. Fade, long signal, 70% confidence. Entry, opening 15-minute range hold. Exit, hit 1.2 target within 90 minutes. While 1.8R. This trade was the first one that convinced me the gap fade logic had statistical merit. The AI bought into weakness in a sector that had been mechanically sold on tariff news without fundamental earnings degradation. The recovery was fast and clean. Trade 2, day 11, ETF rotation long, 82% confidence, highest of the experiment. Healthcare sector ETF flagged by the ETF robot. Entry at a 2-week consolidation breakout. Exit. 3-day hold, plus 2.3R. The 3-day hold required patience. This was a swing robot signal, not a day trade. I had to leave it on overnight, which, in the current volatility environment, is genuinely uncomfortable. The disciplined hold was rewarded. Trade. 3. Day 16. Short signal on a retail name during consumer sentiment weakness. 77% confidence. Clean trend continuation setup. Entry, intraday breakdown. Exit, same session. Plus 1.6R. Trade. 4. Day 22. Momentum long on a biotech name following positive sector sentiment. 73% confidence. Entered on a bull flag on the 15-minute chart. Target hit in 40 minutes. Sub 1.4R. Trade. 5. Day 28. Swing long on a mid-cap industrial. 80% confidence. The setup was a base and break pattern the AI had identified. Entered before close on day 28, exited day 29 morning at target. Plus 2.1R. 3 losing trades. Where it went wrong. Loss. 1. Day 9, already mentioned. Tariff headline killed a semiconductor long that was technically clean. 1.0R. The setup was not wrong. The macro override was unforeseeable by the AI. Loss 2. Day 13. Momentum short on a name that reversed sharply on positive earnings from a competitor. The AI didn't know earnings were coming from a sector peer. The competitor's earnings created a sympathy rally. Stop hit within 20 minutes. 1.0R. Again, not a flawed signal, an information gap. Loss. 3. Day 19. Range breakdown. Long that was a false breakout. 1.0R. This one is different from the first two. The setup failed on its own technical merits. The range broke, the AI triggered the long, price reversed back into range. False breakout. This is a category of loss that no AI or human trader can fully avoid. False breakouts occur in all market conditions. The question is whether your risk management contains the damage. 1.0R is a contained loss. Notice something about those three losses. They're all 1.0R. That's by design. The AI specified stop placement, and the rule was to honor it. Consistent risk sizing is what makes positive expectancy tradable at scale. The losses didn't hurt the experiment because they were contained. This is one of the most important things AI trading tools actually enforce. They remove the emotional tendency to widen stops or hold losers. Total results. 41 signals over 30 days. 34 taken at or above the 70% confidence threshold. 7 skipped below threshold. Of the 34 taken, wins 21. Losses 13. Win rate 61.8%. Average win 1.73R. Average loss 1.0R. Total net 19.1 on YAR over 30 days on a $25,000 paper account. On a $25,000 account with 1% risk per trade, $250 per trade, 19.MAR translates to approximately $475 net gain, a 19.1% return over 30 days. I want to be careful with that number. This is paper trading. Slippage, spread, commissions, and the psychological difference between paper money and real money will all affect live performance. The actual return in a live account would be lower. How much lower depends on your broker, your trade size, and your emotional discipline. This is a best-case scenario figure, not a projection. But the statistical structure is meaningful. A 61.8% win rate with a 1.73 average winner and a 1.0 average loser produces a genuinely positive expectancy. That's a tradable edge, assuming the conditions that produced those results are persistent. What AI trading actually feels like. I didn't expect the psychological dimension to be as significant as it was. Let me talk about it honestly. The hardest part wasn't the losing trades. It was the winning trades I wanted to override. Day 3, the gap fade, I mentioned. I wanted to skip it. It won. Day 22, the biotech momentum play. Everything in me said the sector was overextended. It won. Every time the AI was right on a trade, I would have passed on. It reinforced how much my intuition is actually pattern bias, shaped by recent experience, not statistical edge. That's humbling. It should be. The other psychological challenge is loss attribution. When you override the system, you can always rationalize a loss. I would have gotten out sooner if I'd trusted myself. When you follow the system, the losses are purely the system's losses. There's no escape hatch. That's uncomfortable in the moment, but it's also what forces you to evaluate the system objectively rather than defensively. I used TradeZella's notes field after every trade to record what I was feeling at entry and exit. Looking back at those notes at the end of 30 days, the pattern was clear. My emotional state had almost no correlation with actual trade outcome. I was most confident on 3 of my losing trades and most uncertain on 2 of my best winners. That data is more valuable than the P&L. If you're going to trade systematically, AI or otherwise, journal your emotional state alongside your trade data. TradeZella makes that easy. On-screen graphic, what I'd change for a live account. Honest recommendations. If I were moving this to a live account, and I am seriously considering it, here are the specific changes I would make. 1. Add a macro override condition. Not for individual trades, but for market-wide conditions. If the VIX spikes above a defined threshold, or if a scheduled event like a Fed decision or major tariff announcement is within 30 minutes of a signal triggering, I would pause and take no new positions until clarity emerges. This directly addresses the 2 information gap losses from the experiment. 2. Start smaller. 0.5% risk per trade instead of 1% until I've validated the system performs similarly in a live account. Paper trading win rates often overstate live performance by 5 to 10% due to psychological effects. 3. Stay on the higher confidence signals. The 70% threshold produced a 61.8% win rate. I'd be curious whether moving the threshold to 75% would improve that further. The trade-off would be fewer signals but potentially higher quality. Worth testing in the next phase. 4. Continue the journal. Non-negotiable. The data in TradeZella from this experiment is a baseline I can compare every future month against. Without that baseline, I couldn't evaluate whether performance is improving or degrading. Final verdict on Tickeron AI. Tickeron's AI in the conditions I tested produced a measurable and positive statistical edge. The structure of the AI robots, specialized models with public performance histories, is the right architecture for building trust in a systematic approach. The transparency is meaningful. The limitations are also real. The AI cannot process intraday macro events, and the historical performance displayed on the robot dashboard reflects past conditions that may not persist in future environments. These are not criticisms unique to Tickeron. They're inherent constraints of any rules-based system. What I can say with confidence after 30 days. The robots I followed generated more edge than I expected, in worse market conditions than I would have chosen for a test. That's a meaningful result. Tickeron link in the description. http www.tickeron.com. Davia Dalspari, Black Bear Trading.